How about the comparison with the Dow and gold prices? Should that be something we should?
Yeah, I mean, historically, if you look at it, I think nobody can deny that we're in a heck of a bear market in the equity market right now. And historically, if you go back over the last 100 years, you've seen a 1-to-1 Dow to gold ratio at the bottom. I don't think we're anywhere near the bottom of this bear market yet for a host of reasons. The psychology isn't right yet. Those of us who lived through 1980, 81, 82 can remember what the psychology was. Richard Russell talks about being cursed for telling people to buy stocks in 82. You go along a long period of accumulation when nobody wants to buy stocks again ever in their lives. I mean, I remember it vividly when everybody wanted to buy gold and oil, and the Aden sisters were calling for $4,000 gold, and nobody, including yours truly, wanted to buy stocks. I mean, the psychology was that we're not there yet. When we get there, I think you're going to see, historically, we've seen it several times over the last 100 years when the Dow to gold ratio approaches 1-to-1. Last time being 1980.
Does anybody believe up there we can see Dow at 4,000 and gold at 4,000?
Yeah.
Well,
I think it's possible. I don't know how likely that is, but it's possible.
Absolutely.
I don't know that any of us can predict these things. I mean, I'm a trader, okay? I try and get on what's going up and be long it and get short what's going down.
Amen.
I look at inflation. Inflation to me is a government and then taught at school term is stupid. When I graduated from college, I bought one of 2 new cars I've ever bought in my life because they're stupid. The car was a '64 Chevrolet Super Sport convertible with air. I was really proud of myself. It was $3,200. I still have the checkbook from my first year working for Standard Oil Company. I bought a TV the same year, colored, Motorola 21-inch, $580. Today, the Chevrolet would cost you 40 grand, and the TV you could probably get for $70 at Walmart.
70 cents.
Okay, where's the inflation here? Inflation is a government tracking thing. I believe we're going into a period of what you need is going to go up in price. And what you own, somebody, if you don't, has debt on. And it's going to at least struggle and maybe go down in price. And what you need to do is follow the trends in these things. I don't think the stock market's seen its low. I don't know what the low is going to be. I believe the big arrow is still down, and I just got out of my longs a week ago for this bounce and started going short a little bit yesterday, okay? Because I trade. That's what you got to do. You got to monitor this stuff day by day. The center of financial earth has moved from New York, where it was dumb enough, into Washington, where it's ludicrous. So you've got to pay attention all the time. 29 crashed. They didn't close the banks till 33. If you're paying attention, you already have your money. I think you got to pay attention.
Exactly. My own viewpoint, which we don't trade to at Sitka, by the way, is at Sitka we trade based on what the market is doing, not what we think it ought to, which I think is what Clyde just said. But my own personal viewpoint is that the stock market's going to do something like this. The S&P is going to rise to 900 and then fall to 700 and then rally to 850 and then fall to 750 and then rally to 800 and do this over the course of 5 years, kind of like Japan did, without going anywhere, but going nowhere in an interesting way. In other words, those are huge percentage moves actually if you look at them from where we're at. And actually that's my good scenario, because my bad scenario has the S&P falling to about S&P 500 or so. Now, I don't know that we get there. To me, it's possible, although I really doubt it, that the bottom is in. I'm inclined to agree with Clyde. I don't know where the bottom is. Maybe we just go back and do a double test. Technically speaking, if that bottom doesn't hold, I'm looking at something like 500 on the S&P.
But what we have to realize is that when we're talking stock prices, we're measuring them in an unstable unit of measure.
Yes.
Because you really have to, this is why I think the Dow to gold ratio 1-to-1 has some legitimacy. It's not just a freak number. I think that you have to go back to look at what is real money. I mean, it would be as if you changed a yardstick, took an inch off every year and still called it a yardstick. We're creating money enormous units of currency, units of measure that make no sense. So what is, you know, what is the price of gold going to go to? I don't know, but ask what will an ounce of gold buy. I have a pretty good idea that it will continue to buy the same as it's bought for centuries. And so I think all this talk about where's the Dow going, where's the S&P going, where's the price of gold going is really nonsense. You have to look at what will an ounce of gold buy and think in terms of gold as money and what will that buy.
It's all in relationship here. The lower the dollar goes, ironically, the stock market is going to react quite differently to that. If the dollar collapses here, the bottom might actually in the stock market be higher than if the dollar holds firm. And we don't know what the dollar is going to do realistically because we don't know what the UK is going to do. We don't know what China is going to do. We don't know what Australia is going to do. We don't know what Japan is going to do. So, you know, everyone that thinks they know where something's going and says, here's my answer. So, you know, they don't know, and I don't know either. You know, so
they're all going to devalue their currencies.
And you're all going to be traders.
You all need to be traders.
No. Just remember, you all are going to be traders. Because there will never be a point in time when you can shave the antler off your Krugerrand and go buy a loaf of bread with it. So ultimately, you're going to have to turn the Krugerrand into the currency that the government's letting you use. So you're all traders. You have to do what I'm talking about. You have to follow these markets on your own or call somebody you consider honest and smart and get information on these things as they move. Because we're creating law, financial law, faster than I can read it, and I watch it day to day to day. I mean, we're in never land here.
When we're talking about the Dow and the indices and where the ultimate bottom is, the Dow does have a long-term bearish chart pattern that projects to roughly about 3,500 to 4,000 on the Dow. And perhaps tomorrow in my 9 a.m. presentation I'll add that. But it's a very clear, discernible chart pattern that does target that value. But then again, as Jay said, it really depends upon the unit of measure that you're using at the time.
We got a question in the back, the door.
And Mitch, you mentioned that the markets go where they're going to go, not where you think they're going to go. And Clyde, you said that we need to be traders. And I watch like CNBC and I see 10,000 shares of Yahoo.
Stop! It's CNBS.
Yeah, I know. But who moves the markets? If it's not me trading 500 shares or somebody else trading 10,000 shares, whatever, with 1.8 billion shares traded on the New York Stock Exchange and whatever on the NASDAQ, somebody's moving lots of money.
It doesn't matter. What you have to do is react to what's happening. I think this is what Clyde's trying to say. You have to learn how to trade. You know, if you can't do it, if you can't sell these rallies and buy the dips, then you have to find someone that's willing to do that for you. Find someone that you can trust that's willing to do that. Because, all the time I'm looking at the market and I'm saying, my God, why is this happening? I did a post on gold today and I'm sitting thinking, geez, so why is this happening? And gold for a long time, or actually for most of this year, was following the dollar. If the dollar rose, gold was going up. And a few weeks ago, recently, in the last couple of weeks, that pattern that we've seen all year long started to break down. And so the gold is no longer tracking inversely, or directly with the dollar, but it's not going directly inversely to the dollar either. We've got various seasonal trends in gold that if you held through those things, it was extremely painful last year because the seasonal trade in gold is off. So one has to be willing to bend with what the market's doing and not necessarily trying to figure out why. Because by the time it's apparent that the market's doing what it's doing, the information is useless.